We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Brodrovics. Joining me today is Robert R. Prechter, founder and president of Elliott Wave International, the author of 18 books, including Last Chance to Conquer the Crash, and also the author of The Elliott Wave Theorist, one of the longest-running financial publications in existence today. How are you, Bob?
Doing fine. How are you, Tom?
Excellent. Great to have you today and speak with you. I'm really looking forward to this conversation. Today, before we hit record, we had a really interesting back and forth here. So look forward to getting your thoughts on a lot of these ideas. But I think an interesting place to start here is talking about the theory that you have developed of, let's say, social casualty called socionomics, which the main hypothesis is endogenously regulated waves of social mood prompting social actions. So in other words, events don't shape moods, moods shape events. So I think that's a great place to start and understand a little bit more about that idea to frame today's discussion.
Sure. Most people think the financial markets are mechanical systems and that outside events and forces strike them and make them change. We don't think that's true at all. And we've done a lot of research, and other people have done a lot of research to show that they can't explain from news events why the stock market moves the way it does, for example. When the stock market has a dramatic move, very often there is no serious news. And also when there's serious news, very often the stock market doesn't do anything or goes the opposite way that you might expect. Ralph Nelson Elliott, back in the 1930s, developed a model of financial market movement. He was the first person to recognize that the market moved in a fractal form. He didn't have that word, but that's what he described. And after studying that for a while, I began to realize this is independent of news. And so I figured out or decided that what's happening is that human beings in society undergo waves of social mood. They fluctuate toward the positive and fluctuate back toward the negative, and they do this at all degrees of trend. So it's a rapidly fluctuating on the short-term basis, and then there are long waves of social mood as well. And as social mood gets more positive, people get more optimistic, and a lot of things happen as a result of that. They get in a better mood all over. So you see them buying stocks, for example, bidding stocks upward. You see women wearing friskier clothes. You see more comedies come out and more joy in popular music, for example. The economy expands because people are more productive. And when the trend toward social mood heads toward the negative, you get the opposite of all those things. People bid stocks lower. They wear more conservative clothes. You get more angry or sad music in the pop field. And so people are expressing these moods in all kinds of ways. And those ways get reported as news, especially when, say, social mood is so negative and has been negative for so long that it leads to conflict, like wars and things. We found that wars tend to break out in the second decline in the stock market, which means the second time social mood heads toward the negative. So we began to realize that all the news that people think is buffeting the market is actually a bunch of lagging information that comes out either concurrent with or after the changes in social mood. And you can see this happening only recently. The stock market and social mood worldwide peaked in 2021. Well, here we are in 2023, and conflict has broken out in the Middle East. And we have done a study showing that the Middle East tends to be a very quick tinderbox to blow up after peaks in social mood. It happened in 1967 after the top. In 66, it happened in late 73 after the top in January 73. It happened in late 2000 after the top in early 2000. And here it's happened again a number of months after the stock market topped out. So if you get a handle on it, you can start predicting what people call fundamentals, including the economy.
Is part of this let's say human understanding of linear thinking versus the exponential or, as you said, fractal nature of markets. Is that a way we can explain those disparities?
Yeah. People's brains default to physics because it's been very useful through all our years of evolution to understand physics. If there are hailstones coming down, you want to get under shelter because the shelter will stop the stones from hitting you. If your neighbor's mad at you and he throws a rock at you, you need to duck because it's going to stay in the same direction. That's linear movement. People tend to interpret the stock market in the same way. So the longer it goes in one direction, the more powerfully people believe that it's going to continue because they extrapolate things linearly. But our model is a fractal model, and it helps you anticipate changes in the trend, and it keeps you focused on looking for changes in the trend and signs of those changes, as opposed to simply saying, extrapolating, it's going to keep going in the same direction. And even people who, try to decide whether they should be in the market or not, default usually unconsciously toward that linear way of thinking.
Mm-hmm. I think taking, let's say, commodity prices, defying standard explanations during the pandemic is a great example of all of this, right? We had a global crash in demand, a global economic contraction, and what did the commodities do? They jumped. So how do we look at that through the lens to understand the real drivers here?
Well, I think commodities are also moving up and down in terms of crowd psychology. In fact, in my book, The Socionomic Theory of Finance, we have a whole chapter on oil prices and all the predictions that my oil specialists have made strictly using the Elliott Wave model for the last 30 years. And if anything, it's been our single best market. And most people think supply and demand move oil up and down. And I would have thought that for most of the years of my early life. But we looked into supply and demand factors, and you can't predict oil prices with those. But using the Elliott Wave model, you can predict oil prices incredibly well. But here's a great example. You mentioned commodities. Back in 2011, 2012, gold was up at around $1,900 an ounce. And gold bugs were really excited because Bernanke had just come out and announced that the Fed was going to buy $40 billion of United States Treasury bonds every single month. And he wasn't going to give a time limit. He was just going to buy them until I feel like stopping. Mm-hmm. And the month after that, he came out and said, well, now we're going to buy another $40 billion worth of mortgages every month. And of course, people were saying, oh my gosh, gold's going to go to the moon. This is it. This is what we've been waiting for. And our headline was, QE announcement offers selling opportunity for gold. Now, why would we say that? Because gold had already completed its 5-way bull market upward. All of the sentiment indicators showed that people were crazy bullish on gold, which meant they were already invested. And the only way it could go was down. And sure enough, throughout the entire QE process, that was the first major QE process, or the second one. The first one started in 2008. The gold went lower and lower and lower. It went down from 1920 to, I think, 1,060 or so. And during that entire period, Bernanke was buying and creating new fake money. So you can't, if you use fundamentals, you're going to get trapped every time. Now, using the Elliott Wave model doesn't mean you're going to be right every time, but you can make some great calls against the crowd when you do it.
Mm-hmm. So while we consider all of this, Bob, I'd like to move on to your view on the markets at the current moment. Are we heading for a deflationary crash, and what does that look like to you?
Well, let's back up a little bit and look at some of the craziness that was happening going into 2021. In December of that year, I wrote a special issue called A Stock Market Top for the Ages. It turned out that was right between the two peaks. November 2021 was the top in the broad market indexes, and January 2022 is the top in the Dow, the S&P, and the New York Composite. But the reason I gave it that title was that the 24 sentiment indicators that I showed in that issue were not just indicating that people were a little too bullish. It showed record readings in every one of the 24 indicators that we showed. And we've been showing these throughout the year of 2021. I think we've never seen anything like it. We had record stock values relative to gross domestic product. We had record stock values relative to corporate earnings, record stock values relative to corporate sales, record margin debt. People were going into debt so they could buy more and more stocks. We had record lows in the amount of money that people had in money market funds. They didn't want cash. We had record lows in the percentage of cash held by mutual funds. Usually they like to have a little cash padding so they can buy more stocks if they pull back. But no, they were down to, I think, 3% or 2.5% cash. It's the lowest ever. And one of the statistics I really love to cite because it's so fun and crazy. Ridex funds keeps a lot of data, and we find them very helpful. In previous times, in the highs of 2000, for example, which was a really overvalued peak, and 2007, just before the biggest collapse since 1929-32 in the stock market, people were very, very bullish. So at Ridex, they had 2 or 3 or maybe at the most 3.5 times as much money in the long funds as the short funds. Well, what was happening in 2021? They climbed and climbed, the ratio climbed and kept climbing and finally hit a peak in terms of the amount of money on in the long funds versus the short funds of 60 times. And when we isolated the leveraged long funds versus the leveraged short funds, the multiple was 80 times. So that gives you an idea of how crazy 2021 was. Charles Mackay is going to have to come back from the dead and write a new Madness of Crowds book because that really was something. And when you get readings like that, you don't just get a pullback, at least in my opinion. You get a full-fledged turn in the other direction. And when you get it, it's over. It's not going to come back and do that again. So I think we've made the turn in 2021. And you would think 2 years into a bear market that people would be worried. And we can talk about this too, but right now people are almost as bullish as they were at the top, not to those multiples, but they still are dying to buy stocks every time there's a downtick.
Mm-hmm. Well, that's exactly where I wanted to go next is why do you think this dichotomy of many stocks around the world being weak, bond prices being weak and trending lower, among many other economic and financial indicators being negative, and yet it seems that both professional and individual U.S. investors are just flush with optimism? Where does this dichotomy come from?
You're absolutely right. And it is both professionals and individuals. It's across the board. A couple of things actually set records in the last few weeks. In September of 2023, nearly 2 years after the top of 2021, an indicator called VIX, V-I-X, which is billed as a measure of future, expected volatility. What it really is a present measure of complacency versus fear, reached its lowest level since early 2020. This was just, last month. So even as the stock market topped in late July and then began to come down, and it would bounce and come down and bounce, every time it bounced, people got more complacent. They said, oh yeah, it's just a pullback. We're going straight to new highs. And the proof was in this new nearly 3-year record low reading in the VIX in September. And then in October, my friend Peter Eliades contacted me and he said, have you been looking at the NASDAQ 100 Dow Jones utility ratio? And I said, no. I said, but I bet it's really high. And he said, yeah. He says, let me show you. So he had it going all the way back. The NASDAQ 100 index was created in 1985. So that's when the ratio begins. And back then, utilities sold for more than the NASDAQ 100 did. In fact, the ratio was 0.6. In 2000, it got to, I think, 16 times multiple, NASDAQ 100 versus the utilities. In 2007, it wasn't particularly amazing. In 2021, it got to 18 times. And this month, in early October 2023, it got just shy of 19 times multiple, an all-time record. So people are in love with approximately 7 tech stocks. And they're a big part of the NASDAQ 100 index. They're a big part of the NASDAQ index, and they're a big part of the S&P 500 even. And that's what's keeping those indexes up, this mania to continue to own these few shares. So the mania mindset is still there. And that tells me we're way early in the bear market. We have to get rid of all that kind of thinking before you can even talk about a low.
Mm-hmm. Bob, how do we explain this social mood being so elevated at the time? You know, going back and thinking about this as I was preparing for today's interview, I was thinking that maybe the end of the lockdowns and the depressed mood that COVID caused could be a reason for this. How do you explain it?
Well, we always look at the waves of social mood and the consequences that they bring in terms of social action and events. The stock market completed a bull market wave in January 2018. Then it had a sharp drop. Then it ran to a new high, and another sharp drop, ran to another new high, and then another even bigger sharp drop in the first quarter of 2020. And that's when the bad news came out. Usually the bad news comes out in the last move or toward the tail end of a corrective process. The bad news in this case, which nobody predicted, but that's what emerged, was a pandemic, a global pandemic. So when we saw that, we said, okay, we're finally seeing the sort of social result of this negative mood period. Well, since the market recovered and mood improved, and notice that mood got more positive during the pandemic. Mm-hmm. People are dying in the hospital. It bottomed in March of 2020. That's early. Most people in the U.S. only started preparing in February to early March at the very earliest. I think the first company besides my own, that told people you should work from home came in the second week of March or late in the first week of March. So the market bottoms are, I think, the third week of March, right? Just at the point when you would think that it was just the start of a downtrend because of this terrible thing that was happening around the world. But no, social mood is its own thing. It's internally regulated. When it's over, and mood begins to go back toward the positive. And that's what happened. And by the time we got very positive social mood, of course, most of the pandemic was over in terms of deaths anyway. It's probably be with us forever in terms of the virus. So we look for results. So then what happened? We got into the top in late 2021, early 2022, and the world was rosy and everything was great and interest rates were low and the Fed were geniuses and the economy was doing just fine. And since then, mood has trended, I wouldn't call it negative yet. I would say less positive. It has gone less positive, and we've seen some results. We've seen lower, somewhat lower stock prices. One of the things that we tend to see shortly after major tops is conflict breaking out in the Middle East. We had it in 1967, the year after the top in 66. We had it in late 73 after the top in January 73. We had it in late 2000 after the early 2000 top in the stock market. And here we had a top in the stock market 2022. And in 2023, you're getting conflict in the Middle East. So we look at these outside things as results, not causes.
So putting a name to that point of time in, let's say, 2021 to 2022, you called it the grand supercycle top. So does this method also use some cyclical analysis as well?
Grand supercycle is just a word that Elliott coined to indicate a very large degree of the fractal trending, fractal pattern. But we've been saying from the beginning that the bull market that started approximately 1784, when you go back and use British stock prices, was a new grand supercycle. It's a very large move that's going to last a couple centuries. The previous period had given us a bear market from 1720, which was the top in the South Sea bubble in England, to 1784. It lasted 64 years. We said we're going to be going up for decades and decades and decades, a couple centuries, in what's called a grand supercycle degree uptrend. We've been anticipating, the top of that for quite some time, and I think it finally happened in 2021. So it's a big deal. It's not just another top like 1966 or 87 or 2000 or 2007. It's a much bigger deal. It's almost like looking at, say, the top in the peak in the Roman civilization or something. I don't think it's that big because that was an even bigger degree back then. But I mean, it's going to have implications probably for much of the rest of this century. We're not going to have that party atmosphere of 2021 again in the financial markets. You've already seen a massive change in the bond market. I know you're following that.
Mm-hmm. Yeah, we'll get to that. But one of the, I think, interesting examples of the result of this social mood is Bitcoin. You know, you guys started writing about it when it was at 6 cents. So how have the waves of optimism really enabled the Bitcoin craze, and does it have further to fall from here now?
It's a great question, and it's a wonderful example of how waves of social mood are in charge. Bitcoin started up in around 2009. It was started at a penny. My son got really interested in it. He said, "This is an alternative currency. It could be really, really cool." So I had him write up a piece, and we worked on it together and published it when Bitcoin was 6 cents. And we said, it's a free market type of form of money. It can't be inflated. Once they create the last Bitcoin, it can only be deflated. So it's going to be a great store of value if people adopt it. Well, then that was the exact low year in the stock market. So we had a period of negative social mood at the bottom of March 2009. So what happens? We get into a period of positively trending social mood, and things start to happen. One is the stock market goes up. Another one is Bitcoin starts going up and starts getting a little bit of press. And then it went to $1, and then it went to $10, and then it went to $100, and it went to $1,000. And we were like, man, this is incredible. Then it goes to $10,000. And we were like, oh, this is getting a little bit crazy. Well, somewhere along the line, people began to realize that Bitcoin, because it was starting to be adopted by some retail people, sellers. And they said, if you want to buy our stuff with Bitcoin, you can do that. And they began to find out that the blockchain wasn't built for the kind of volume that you can run a global economy on. It's too slow. And so we thought, this is crazy. It's way up here at $10,000 an ounce, or 20, whatever it was at the time. It's got to be near the end. And now they've discovered the blockchain doesn't work properly. It can't hold it. I mean, if somebody comes up with a better coin, Bitcoin could go to zero. Social mood didn't care. It goes to 30,000, 40,000, 50,000, 60,000, 70,000 because people had the bit in their mouths. The mood was getting increasingly positive. They just bid it up. If you ask them why, they'll give you a million reasons, but it was because their mood was improving, certainly in the aggregate. Bitcoin topped when? January 2022, the exact same month when the Dow, the S&P, and the New York Composite topped out. That is social mood bulling up several things at once. And when we were talking earlier, before we started recording, we talked about NFTs. And that was probably the icing on the cake. And the fifth wave of the fifth wave, as we call it, the final move, people started paying money for nothing. I mean, these little bits of code that would appear as like a multicolored cartoon that you could own, you lucky thing. And people
the only one.
Yeah, people bid, yeah, the only one, right. But you could just take your camera out, take a picture of it, and you've got almost the same thing. Is it really worth $1,000, $10,000? How about $1 million? Some of them went up to $1 million. And as soon as the bull market was over in January in stocks, the bull market in NFTs ended simultaneously that very month. And down they came, almost back to where they started.
So do you think that with the advent of the Lightning Network, which gives the Bitcoin network the ability to handle a lot more volume, do you think that evolutions in Bitcoin itself will make it a more viable currency?
Yeah, that could definitely happen. It could be a more viable currency, but it's not going to cause it to go up or down. Social mood is going to be in charge of that for sure. Mm-hmm. And just as people ignored the blockchain problem on the way up, when they start selling, they're going to say, I don't care. Yeah, so it works. It went too high. 70,000 was crazy. Let's get it back to under earth, and they'll have all kinds of reasons, just as they had reasons on the way up. They'll rationalize all the reasons on the way down. But yeah, it would be great if that were to happen because, centrally planned money is not good.
Well, sticking with that theme of the social appetite for these things, do you think that Bitcoin was the answer to this social appetite of wanting a currency that was uninflatable and non-manipulatable by central banks?
I think it was a great invention, a brilliant invention, and I would say mostly yes. Unfortunately, now the central banks and governments are talking about, we're going to create our own digital currency. Well, that's the opposite because it's going to give them complete power over everybody's deposits who uses whatever digital currency that may be. So the dream during the positive mood period could turn into a nightmare in the negative mood period. That's how things operate. Social mood is in charge, and all the great things about it are going to turn into bad things about it. It's just like, nuclear power. It can be used to generate electricity, which is a wonderful thing, or it can be used to blow things up, which is a bad thing. And during negative mood periods, they tend to use it for bad things. So keep an eye on social mood, and sometime in the future, there may be a time when it's time to buy some of these cryptocurrencies. Here's another amazing thing. We were shocked after Bitcoin that people started to invent other crypto coins. What's the point, sort of? And some of them were jokes, like Dogecoin, a picture of a dog on it. And it went up to crazy prices. And there was a time when the number of coins got up to 600 plus. And we said, this is crazy. Well, do you know now there are 1 million coins trading on 600 exchanges? So that's how crazy that thing got. Mm-hmm. This is all going to have to get unwound. A lot of it anyway, and get back to normal before we can build a base for another bull market.
Mm-hmm. Well, I mean, we'll move on to talking about the idea of real money, which is a concept that you brought up to me earlier. But before we get to that piece, I want to talk a little bit about considering this the top of the grand super cycle because of the low interest rate environment that we enjoyed for much of the last 40 years. Do you think that this marks, or adding to that, do you think that this marks a bomb exploding in slow motion in the debt markets here?
That was, I think, a great result of positive social mood as well, because here we have the central banks printing money, have government spending money like drunken sailors, and people are like, well, we don't care. We don't need any interest. 0.5% is fine with me. Thank you very much. Because all I could think about was speculating in stocks and Bitcoins and NFTs and whatnot. Well, that era is over. Negative rates. Who in the world would predict that you would pay the government to lend it money? It doesn't even make any rational sense. And that's the whole point. In our model, markets are not rational. They are pre-rational. They're run by your herding instincts and your mood. And so when positive mood peaked, all those things changed, and we started an uptrend in interest rates as well, getting back to normal areas. So while mood is trending negatively, you're going to have people are going to say, I'm a little skeptical this time. I'm a little worried this time. I'm skeptical. So I want you to, if I'm going to lend you my money, I need a decent rate of interest. And it may come to a point, if we get into a recession, depression, or anything like that, where people say, now I'm really afraid to lend you money. And so the borrowers are going to have to continue to say, okay, how about 16%? How about 20? To some company, for example, that's on the brink of bankruptcy. I mean, how are they going to get people to lend it money without offering them more interest? Mm-hmm. So I think we've already slowly edged our way into a less positive social mood, and we're in a new trend that's going to last for quite a long period of time. You have to adjust early if you want to keep from getting hurt. So, and we're going to talk about this, I know, a little bit later, but protecting yourself is key here.
Well, that brings up the idea that you shared with me earlier, again, before we hit record here today, of the idea that the Fed really doesn't have the control that it presents the illusion that it might. It doesn't have the control of the interest rate market. So can you share a little bit about the studies that you have done on the actual control that the central banks really do have?
Yeah. Yeah, they foster a myth, which is that they control rates. And they talk about all their meetings and how they decide, where they're going to set rates. And everybody believes them. It's amazing. But we've gone back decades and decades. We've studied 6 different major central banks around the world, and they all have the exact same policy, which is they follow the rate set by the market for Treasury bill rates of interest. So when rates on Treasury bills are very low, they set their rates low. And when they start to move up, they wait and they watch. And when they get a certain distance away, they say, we need to start catching up, and they start raising their rates. We found that the average lag time is 5 months for all the central banks to follow, the market set interest rates. So when they have meetings, they're not doing anything but looking at the rate and deciding, are we close enough to the free market rate with our own Fed funds rate or not? And if we're not close enough, we need to change the rate. So, we can predict what the Fed's going to do all the time. We just look at the T-bill rate and we say, okay, they're going to kick it up, probably another quarter point or half a point, whatever. And then on the downside, same thing. Back in 2007, rates were 6% and T-bills, and they started to fall, and the Fed starts lowering its rate. And everybody goes, oh, they're trying to lower the rate to improve the economy. No, they're lowering their rate because T-bill rates are falling. They just follow. So they have not exercised any control over interest rates. They theoretically could. They could set their Fed funds rate way different from what the market is doing. But since 1913, they haven't done that. So what power does the Fed have? It has only one, and that is to create or destroy new money. Most of the time since 1913, all the Fed's done is create new fake money, mostly at the behest of the government, sometimes at their own decision. And in recent months, or the last year or so, they've actually contracted the money supply a little bit, which is kind of cool. I think that is probably a reflection of even the Fed getting a little more conservative. Something like that happened in 1930, 29, 30, 31. The Fed, got conservative, and they sort of said, yeah, we'll take your, some of your bank debt, but we're only going to take the AAA, the best of all of it, on our books. So something like that's happening now. They're saying, maybe we ought to bring in the money supply a little bit. Who predicted that? That was kind of crazy. So we always look at what is social mood doing. Okay, the last thing about the Fed I'm going to say is negative social mood is eventually going to make people angry at people who have been in power. That means the incumbent, his popularity's already been falling with the Russell 2000. For the last 2 years. And the Fed, I think the Fed is going to have a very negative reputation before this period is over.
Well, I actually did see a piece in one of your recent newsletters that you can use the Elliott Wave method to also predict exactly, as you said, the approval rating of the current president, which is, interesting to be able to see that as well, right?
Yeah, because when people are in a good mood, they kind of say, oh, yeah, the leader's great. And we'll credit him for us feeling good and the times being good. And when the trend is negative, they blame the leader. We actually, my colleagues and I did a study. It was an academic paper. It was published by Sage Open, I think back in 2012, called Presidential Elections and Re-elections, in the stock market. We found that when an incumbent is running for re-election, the previous 3 years of stock market direction, which is a reflection of the direction of social mood, is an extremely good predictor of whether or not he's going to get re-elected.
Yeah, and that's interesting to consider all of these things heading into an election year, which is here in about a year away, right?
Yeah, and the election is 13 months away. So, we're getting close to that. And presidential approval isn't in lockstep with social mood, but it tends to follow pretty closely. The few times when it completely diverges from social mood is when we get in a war situation. And then there's something deep in the human psyche that makes a rally around the leader whenever there's a threat from the outside. I think with the highest presidential approval ratings ever was George Bush II when he went into the Middle East. I think he shot up to 91.5% approval for that period of time. But negative social mood caught up with him eventually, and he ended up also having one of the lowest presidential approval ratings by the time he left office.
Mm-hmm. Bob, going back to the idea of the interest rate market really setting itself based on the availability and the willingness of lenders to supply credit, how is this going to affect the commercial real estate market and also extending into the residential markets?
Yeah. Now, listen, you've just lit on a really important point, because it's been a subtle change in social mood since the high in 2021. And when you look at places like the stock market, people are still in a manic frame of mind, and every pullback they think they want to buy. But you can see the result of the problems showing up in areas such as commercial real estate, and it's about to show up in residential real estate as well. And it had to do with a lot of factors, not only mood factors, but certainly when mood began to trend a little bit more negatively, that's when it all came out. One of the things was people were working from home after they learned from COVID that they could do that. So they didn't need to go to the office as much. Mm-hmm. But the big problem isn't the fact that some people own buildings and they're not full. The problem is that the optimism of the positive mood period caused them to borrow and borrow and borrow, not only to afford to buy the building, but to run the business that's in the building. And investors were so blind to the risks that insurance companies and pension funds and mutual funds and all these other things were buying these packages of debt based on real estate IOUs. So it was the optimism that caused them to lend all that money to those people. And now they're starting to realize, oh, I don't know if we can get our money back. And some of these people are just defaulting and saying, I'm sorry, you can take the building if you want. You can run the restaurant, you can run the hotel. Good luck.
So is that going to extend as well into the residential markets because of this, the optimism of borrowing and just even the ability to service the types of mortgages that people were taking out in that realm of optimism?
I think so. And one thing that happens in positive mood is that people think everything's an investment. So they buy Bitcoin, they buy NFTs, they buy commercial real estate, and they buy houses. And what happened after I figure one of the periods when we had a pullback, I guess it was back in the 08, 09, 2011, 2012 period, when real estate had a strong setback, Wall Street got interested. They said, let's buy thousands of homes, package them all up, and make a business out of owning these homes and renting them out. We've got homes in our own neighborhood owned by these corporations. Well, nobody's ever here. Nobody's watching what's going on. But this crazy optimism made them think this was a good idea. The problem is when they start realizing it's a bad idea, which is going to happen while mood is negative, they're going to realize, what in the world were we thinking? Because you have a landlord is a busy person. He's fixing stuff, he's collecting rent, he gets calls in the middle of the night, hey, the heater went off, and you find all these things happening. And I think it's the investors that bulled up the prices to such crazy levels, including residential real estate. They're currently the least affordable they've ever been in the history of the country. And I think for that reason, they became investments instead of consumption items. And when the investors finally give up, just like they did in NFTs and like they're doing in Bitcoin and like they're slowly doing in other areas, they're just going to throw the stuff out. They're going to want to clean the books and get rid of it. Mm-hmm. And then houses, they'll be pretty beat up because they've had renters in them all this period of time, but they'll be back on the market. If you want to buy a dream house, just hold on a little bit longer.
Well, taking all of these things into consideration, let's say the interest rates, the value of these bonds, what does that in turn mean for the value of the dollar as well?
Oh, interesting question. I think what's slowly happening here is a shift in interest away from traditional investments, and that would be the stock market and real estate, and toward things that are either money or they're close to being money. So the US dollar bottomed pretty much with the stock market and with low interest rates. And the US dollar's been climbing. Just a little bit ago, it was down at 99.5, so up to 107 now. The dollar index, for example. People are putting more money into money market funds. And gold is beginning to perk up again. We think gold is in a very interesting position on a long-term basis. From the bottom in 2015, December 2015, gold's been going up, and it seems to have traced out. It's a 5-wave move, which is a bull market style move, and I think we just bottomed in wave 2 of 5, to be specific. My colleague Steve Hochberg runs our short-term update 3 nights a week. He updates gold on a short-term basis, and he called the recent top because we had 5 waves into there. And then he said we're going to have a 2-step decline, which is exactly what happened into a couple of weeks ago. And then it started rising sharply ever since. The 3rd wave is the strongest move. So we're looking for a pretty strong thrust right now into new all-time high territory. And I think it's because people are looking to alternatives from the traditional investments which have been pushed up to ridiculous prices, and now they're looking around. Now, silver tends to follow gold on it, roughly speaking, but it's an industrial metal much more than a monetary metal. Mm-hmm. And the only thing I would say about silver, I don't want to try to get specific on wave counts or anything, but it's the only market I know of that's cheaper today than it was in 1980. That's 43 years ago. Mm-hmm. So it's cheap. That's for sure. Whether it's going to go up or down, I don't know. And I am concerned about a deflationary crumble. I think a lot of debt is going to not be paid. And so eventually that's going to affect commodity prices. But at least for the time being, people are looking for money.
Mm-hmm. Are there any ways to, when you're considering that deflationary crumble, are there markets that are very tied to each other, or is in a deflationary impulse like that, do you foresee, pieces like real money, like gold, taking some of the brunt of that risk off time and just being able to sell anything that has any value to try and cover those times before a recovery in some of those assets that have real value come back?
That's very insightful, because a lot of times when I'm interviewed about gold, they say, well, it's contracyclical to the stock market. Like, no, not really. And 2008 was a great example. People said, oh, the stock market's going down, we should own commodities. Commodities had the biggest drop they've had in a long time, concurrently with stocks. That was a deflationary episode. So the stock market collapsed 50-something%, 56%, and commodities went down a lot. And even gold, even though it was in the middle of a bull market, had a period in 2008 where it came down with everything else. So, yeah, those kinds of things will be involved as we head into this negative mood period. It's going to be tricky. But I think coming out the other end, you'd much rather be long money than the old style traditional investments. That's for sure. And if you have them, here's the cool thing. If you've got gold and if you've got dollars that are safe, and you're in short-term money instruments, for example, as long as they stay safe, they may not forever, but at least for now, you're going to be in a great position, because while everybody else is losing, 10, 20, 50% or more in their traditional investments, you'll be able to look around and say, hey, do I want to buy this house? These stocks are down 90%. Should I buy them now? And so forth. So you're going to be in a great position. That's what my whole thing about Conquer the Crash is, don't get caught in the downdraft. The number one thing is get safe. There are a couple steps you can take to do that, but that's my focus. I'm not the kind of person that says, go out and sell short and do all that kind of stuff. If you're a really real professional and you can handle it, that's great. Most people can't stand the pressure. And also, I don't want to stand the pressure of being wrong. Some people recommended puts, for example, in 2021, and that's all well and good. The market's lower, but it's gone lower so slowly that the time premium's all but eaten up. And so sometimes those derivatives can be very tricky ways to play the game.
Well, exactly in that vein, something you mentioned to me earlier was the idea of these 0-day option expirations that are being sold in the market right now, this kind of derivative of a derivative. And that really marks another symptom of the very top, the very frothiness top of this point in time, right?
Yeah, that's the incredible thing. Even though the stock market topped out almost 2 years ago, we've had periods of crazy overvaluation and speculation, and we talked about some of them. Well, one of them was just a couple of weeks ago, they came out with this new ETF, as you just pointed out. And inside the ETF, they trade 0-day expiration options, which mean options that only survive for a few hours. So the 0-day options got popular because it's kind of the last gasp of gambling. It's almost like a roulette wheel, really, whether you're going to make money that day or not. So some bright person said, let's make an ETF out of it because everybody buys ETFs, and if we say we're trading these things, they'll love it. And it turned out to be true. So it's really funny. Another one which happened recently was we saw an announcement from a bank, and they said, we've set it up now so that you can trade the stock market with as little as $10. So they've gone to the lowest common denominator possible and trying to find the last unsophisticated dollar to stuff into the stock market.
Yeah. Again, that's, I think, a perfect symptom of really just trying to push every last little bit of air into that bubble, right?
Yeah. I mean, forget the shoe shine, boys. This is way below that.
Mm-hmm. You mentioned an interesting phrase just now is the idea of dollars that are safe. So considering the banking issues that we saw in March of this year, many guests that I've spoken with believe that this has been the kind of the tip of the iceberg. But instead of the Fed and Treasury bailing out banks next time this happens, could we see bank bail-ins instead of bailouts here? Yeah,
there was an article online that I excerpted in the latest issue of the Elliott Wave Theorist, and a subscriber actually brought this to my attention. It was part of, I think it was Dodd-Frank or one of those laws recently, and it's fully in place. It's in place in the EU as well, where the government doesn't have to bail out anybody anymore. The FDIC doesn't necessarily have to do that either, and they don't have the funds to do much if there's a systemic problem. So what they're going to do is, they call it bail-in, but it really is a way of socializing the losses inside of a bank. So in a typical bank run, people who are worried go there and they withdraw their money as fast as they can. And so the first people to the window get their money and everybody else is stuck. The window closes and the bank said, I'm sorry, we don't have any cash. It's all lent out. So what this law says is that the regulators can step in and revalue everybody's accounts. So if the bank says, gee, all the money we lent out, half of it's gone. The people defaulted on the loans, the deals that we did. So they just revalue everybody's account at 50% of the previous value. Instead of saying, well, instead of $422,000, you got $211,000 in your account now. Sorry about that. So that is something I'm concerned about, and I think most people should be concerned about early. And I'll tell you what, if you wait until things are scary, it's much harder to take action because your emotions are coming to the fore. So that's another reason why I wrote Conquer the Crash in this latest version, which came out in January 2022. That was the month when the blue chip averages topped. And I gave several things that I think if you want to protect yourself, it's not just about, going to money market funds. There are other things you have to think about. One of them is the viability of your bank.
Mm-hmm. So what are some of the other steps to, getting safe in this time, considering that we're, let's say, 2-ish years past this cyclical top?
Well, one of the things I've recommended in Conquer the Crash was something called floating rate notes, FRN. So they're 2-year notes by the U.S. government, but they're set to the T-bill rate. So they fluctuate with the T-bill rate. It's fantastic. You don't have to roll over your T-bills. They're rolled over automatically inside the note. So they went from 0% to 1% to 2 to 3 to 4 to 5 and currently 5.5%. And all the other bonds are going down in value, whereas the FRNs go up and up in value. So that was a little known thing when I wrote it up. I never saw anybody talk about those. And now you see an occasional mention. Hey, these were a pretty good idea a couple of years ago. You should get in them now. Well, now's okay, but it's not the ideal time. But to me, that was the single best investment. You're now earning 5.5%, basically free in what is currently a no-risk situation because it's short-term debt of the U.S. government. Another area which you're into, is the metals. I think people should have a store of gold. It's the only real money. I think if you're in the US, you should have some bags of junk silver, that is pre-65 US silver coins. Only if a period occurs where, the money system is in trouble and banks are closing and there's a problem, you'll still be able to buy stuff because people can recognize an old coin and they'll value it more than face. So I think that's important. I think you should have at least one account offshore in a safe jurisdiction. My opinion on where the jurisdiction is safer has changed over my professional lifetime. So, the institutions I have in mind don't really want to get advertised. So people who buy Conquer the Crash have a landing page. We offer a landing page, and you can go there and you can get the information about, a highly liquid bank that I believe is very safe, and it's offshore and it's outside, the U.S. banking system. Doesn't mean you want to move all your money there, but it's nice to have a place that is controlled by different entities, at least, and entities that are pretty strong on privacy and so forth. Another important thing is where do you store your metals? I looked around a long time until I located a storage facility. Again, it's offshore, and I think it's extremely safe, and again, outside of areas where things can get confiscated. That's another one where if you pull out Conquer the Crash, go to the landing page, it shows you exactly what to do. It'll take you to a special, I have a special offer with the firm. I called them up and I said, I want to recommend this. Can you give my readers a deal? And they said, yeah, we can do that. So you can have storage fees that are less than their normal rates if you go to my landing page. So there are a lot of benefits in Conquer the Crash. And the last thing I'd like to bring up is, and this may be a little too much for most people, I don't think it's a bad idea to have a second passport. If somebody gets in charge of the country and said, well, things are dangerous out there in the world, we really don't think we're going to honor passports at our borders anymore. It might be good if you had a passport, from another country. So I've got an idea there as well. And, I met an offshore lawyer who handles these kind of things. And if you're interested, you can hook up with them as well and get a really good rate. So those are kind of the 5 major areas where I think if your goal is safety in difficult times, those are the actions to take.
Absolutely. And, to your point, Bob, I had a recent experience of, let's say, the disparity between passports. I was recently in Africa traveling with a group of friends doing a motorcycle trip. And when we crossed the border from Botswana into Zimbabwe, we had to pay for individual visas. So a bunch of the guys were from South Africa. They didn't have to pay anything. There was a German guy, I think his fee was $50 US. And for some reason, a Canadian passport was a $75 fee just for the visa. So, I mean, that's a very simplistic example of the idea of having a different passport, maybe saving you a couple of bucks, if not some freedom to get in and out of different countries.
Yeah, and another important aspect of all this is, one reason I put out the book early is that it's good to act when you have opportunities available. Years ago, I had recommended a bank in the United States that was the most liquid and, at least on paper, the safest bank in the country. Now, they weren't in a state other than where I live. But a few years later, they closed accounts to out-of-state people. You couldn't get it anymore. And the same thing on a passport. The type of passport that I thought was probably the best bargain was great for the last couple of years. And all of a sudden, about 2 months ago, they doubled their price. Now, it's still, affordable if you're a rather wealthy individual, but it's still double the price. And if you'd acted early when you weren't afraid, you could have gotten it for half price. So it's good to act early. There will be times when these programs go away. The international tensions, they're like, we're not letting anybody in, So do it when you can.
Mm-hmm. Excellent, Bob. I understand that you guys have set up a specific landing page for Palisades Gold listeners that has some bundled deals for them if they're interested in this stuff, right?
Yeah, we got some free stuff. I think one of them is a report, how to handle difficult times or something like that. We also offering Conquer the Crash for about half price, only if they're on your landing page, though. And I think if you click there, you'll also find a bargain on our subscriptions if they're interested in that, because we do cover gold and silver constantly. But we also cover the bond market and the stock market, commodities, and anything else you might be interested in, I think. So the destination is elliottwave.com/PGR.
Perfect.
For Palisades Gold Radio.
Excellent. I appreciate you setting that up for our listeners there.
And I should, if you're going to go online and look for us, it's Elliott with 2 L's and 2 T's, wavelikeonocean.com/PGR.
Excellent. And of course, you guys are available on Twitter as well at Elliott Wave, 2 L's, 2 T's, INTL for international, right?
Good for you. My marketing people might know that. I don't.
Excellent. Excellent, Bob. I really appreciate your time and explaining all of this to our listeners today.
Yeah, it's been fun being on, and we'll talk again one day.
Absolutely. Thanks, Bob.
Okay, take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.